On today's hot sheet, I'm discussing the FOMC meeting, the Fed's updated inflation forecast, and what Jerome Powell had to say about the housing market. Today is Thursday, December 14th, 2023. I'm Tom Toole, and the hot sheet starts right now. The industry's only live daily news show on the internet, brought to you exclusively by BAM. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And what a day to be guest hosting with the Federal Reserve meeting, positive comments from the Fed. The market's reacting beautifully, and there's a lot to go over. So I'm going to jump right in, and we're going to start with the Fed meeting. Biggest news out there, probably the most exciting news that we've seen in a long time from the Federal Reserve, because they held the key interest rate steady for the third consecutive time, maintaining a targeted rate between 5.25 and 5.5%. And this is what was expected. However, the big news here is the comments, right? What Jerome Powell had to say afterwards. And fortunately, he didn't come out with a hawkish tone. He came out with positivity. He gave the markets an early Christmas gift instead of being a Grinch. And what happened was, if you look at the indication of future rate cuts and what the FOMC, which is the Federal Open Market Committee, they indicated they had plans for at least 3 rate cuts in 2024, assuming they're going to be in quarter percentage point increments. And that's a little less than market expectations of 4 cuts, but more aggressive than they have indicated for a long time. And this is what people hoped would happen. All the folks like Logan Mohtashami, Lance Lambert, people that want to see the Fed back off this aggressive rate hike environment. And it wasn't so much the lack of a rate hike. It was the comments afterwards, and they were very positive. And we saw the market respond beautifully. The Dow Jones jumped over 400 points, going north of 37,000 for the first time ever. So let's think about this. The Dow rallied so much after these comments, they hit a new high, over 37,000. We also saw mortgage rates locally. I was seeing quotes yesterday at 6.375%, 6 3/8%, which, if you want to engage your consumers and your clients and your database and your prospects, that is something I'd be shouting from the rooftops right now, which we'll get into in a second. And I got some tactical things you can take away at the end of the show here to go shake the tree and find people to help that you've already been in touch with that maybe were a little scared by interest rates. So this is all great news. You could not have asked the market to react any better than what we saw yesterday. Then you have the dot plot projection. So if you don't know what the dot plot is, it's a map of the members of the Federal Reserve, and they map out expectations based on where they see rates going, where things are coming in, and where they anticipate the market's going to go and what the Fed's going to do in the future. So it's basically a prediction visual. And we can probably put that up. There's some charts you can actually download on BAMX, which I know Bobby and the team will make sure are available. This dot plot here is very fascinating. And really what it looks like is the dot plot, which is the voting members of the Federal Reserve. They indicate another 4 rate cuts in 2025. That's where they see rates settling in, which could total a full percentage point, a full point down from where they are right now in that 5.25 to 5.5 range. So that's first and foremost. In addition, they look at 3 additional rate cuts in 2026. So we're talking about rate cut after rate cut after rate cut. Thank you, Bobby, for putting this up. And if you look at where they would end up in 2026, we're talking about a range of 2 to 2.25%, close to the long run outlook. So to me, this is something that we've all got to be really excited. There's some great visual there. It looks like the Madden Telestrator that we're using on the dot plot live on the show here, but you can see the majority of people are down in that range. We're talking about a rate cut environment for the next 2-3 years, which is very, very exciting and bodes well for housing long term, for affordability, for inflation. So tons of good news here. I mean, I'm feeling like Santa Claus just delivering this on December 14th. Then there's the market expectations versus the FOMC. So markets are pricing in a more aggressive rate cut path. So what the markets are seeing and what they're anticipating is that they're looking at 1.5 percentage points in reductions next year, which is double the FOMC's indicated pricing. Now, will that happen? Who knows? These are just predictions. What I'm clear on is we've got the Fed to calm down a little bit. We're going to get into the comments on what Jerome Powell said in a second, but the market is reacting really, really well. And they're even forecasting more with the Fed's coming out and saying. Policy tightening, right? This is something that the Fed constantly talks about. And the statement mentioned that the committee would consider multiple factors for any more policy tightening, suggesting the shift away from the rate hikes. That was the big comment. That's what people wanted to hear who were calling for the Fed to stop the rate hikes for the past, it feels like it's been 6-9 months with a lot of experts out there, a lot of people within the industry, and now it's actually happening. So as usual, the government's the last to the party, but I'll take it. It's a good day here. Balance sheet reduction. So the Fed is allowing up to $95 billion a month. That's billion with a B in proceeds from maturing bonds to roll off its balance sheet. And there's no indication of curtailing that policy and continuing to tighten it. And the new language I see here, and this is something you knew the Fed was never going to do this. You knew Jerome Powell would never do this. Come out and say, hey, maybe 2% inflation isn't a realistic target. Rather, what they did is they revised their targets. You got to love how government works. And if you look at what they're talking about here, because inflation has eased off its highs over the past year, the Fed officials see core inflation falling to 3.2%. By the end of this year, 2.4% in 2024, and maybe reaching that target in 2026. This is key language here. When I read between the lines, when I listened to the statement, when I reviewed all this as being a knowledge broker in the industry, what I saw was they're realizing 2% is probably not going to happen. And they've got to stop hammering this home because the economy is feeling the effects of all this. And they might have been wrong about the jobless recession. A lot of people have come out and said that because we're not seeing this positive reaction to unemployment going up, which we're going to get into. So inflation outlook is now a little more positive. They're still targeting 2%, but they've kicked the can down the road for 2 to 3 years. So you're very welcome, Beth. Glad to be doing this. So economic growth. This is what has been really strong. I mean, the economy hasn't slowed down. The housing market has been a little different, as we know. Excuse me. And the statement noted that while the economy has slowed, recent indicators suggest a substantial slowdown in economic activity from the strong pace, right? So a slowdown from a strong pace doesn't mean it's a slowdown. It means it's a normalization. And I want to really be clear on that with everybody. No one is indicating that they see the economy slowing down. It's just the growth rate is slowing, right? So I think that's really key information you want to share with people. And GDP is still expected to expand around 2.5% for the year as a whole. And what we saw, in the month of November was an increase of 0.75 of a point. In December, it's projected at a 0.5 of a point. So we're seeing that GDP is still expected to grow, just not at that same really fast pace that we saw in the third quarter, which, considering we're in the holidays and there's a lot of spending going on, that's very fascinating. The GDP forecast, the committee upgraded its forecast for GDP growth up to a 2.6% annualized pace. You're growing by 2 to 5% year over year when you look at housing prices or GDP. That is solid, sustainable growth. That is a healthy growth pace, not what we saw in those unicorn years right after the pandemic. So, and that's a 0.5 percentage points increase from the last update in September. And GDP is projected to be at 1.4% in 2024, unchanged from the previous outlook. So if you don't know what GDP is, I find that, we talk in these acronyms all the time. I like to break this down for the simple folks like me that need this information. GDP is the monetary value of goods and services that are bought by other people that are manufactured by a single country. And we're talking about the number at the time it goes to retail sale. So the monetary value of those goods and services that are manufactured, and services obviously aren't manufactured, but hopefully you're understanding what we're saying here, by a country. So that's U.S. Monetary value of goods and services. The unemployment rate. Here's the next part of the statement. Projections for unemployment unchanged with a rate of 3.8%. And it's been hanging around there for a while. So 3.8% in 2023, and it's going to rise to 4.1% in subsequent years. That's very stable. And what we're seeing a lot of right now, I mean, I can speak from this just from a real estate industry, is you see people where they're maybe got into real estate sales. They got into a job like this where it's commission-based, and now they're actually moving out of it or claiming unemployment because there's less property selling. So there's a little bit of these things going on, and that goes with any sales job or any commission-based job that's out there. So remember, unemployment's a funny number because people actually have to file for unemployment. In the generation of side hustles, which I'm a big believer in a singular focus, we're not going to get into that. But in the generation of side hustles, you see a lot of people aren't filing for unemployment because they got multiple jobs, but maybe they're not doing really well at anything. So that's something to consider there as well. And lastly, the future actions. And I would say it's about damn time for this. Officials stress their willingness to hike rates if inflation flares up, because they're always going to say that. Well, if things don't go well, we'll be ready to hike rates again. But they emphasized patience in assessing the impact of previous policy tightening on the U.S. economy. And I've said this before, the last time I guest hosted the show and on the Knowledge Brokers podcast, that there was a lot of micromanagement here. Imagine you're in front of a fire, and as soon as it gets a little too small, you pour a bunch of gasoline on it. And as soon as it gets a little too big, you dump water on it. That's kind of what the Fed was doing instead of letting it burn out a little bit and letting things play out, which we know are what works in business. And let's face it, the Federal Reserve is running a business here. It just happens to be the U.S. government. This is the most important part of the statement. That's the good news here. And it's about time the Fed came out and said that. So that's the statement. We got to break down there. Let's talk about the inflation forecast. So there's a summary of all the economic projections. CNBC did a really nice job putting all this together, and there's going to be 3 charts you can download from BAMX around this. The first thing we're going to discuss is the Federal Reserve lowered its inflation forecast. This is saying, hey, we're wrong in a really nice way without admitting it. With the core personal consumption expenditures, the PCE price index is expected to fall to 2.4%. Long-term inflation targets, the central bank predicted that core PCE will decline to 2.2% by 2025. Here's the chart. Thank you, Bobby. And reach its 2% target in 2026. That is a very different rhetoric than what we've heard, which is we got to get to 2%. We got to get to 2%. Now it's saying, hey, it's going to take us a couple years to get there. So we're going to stop what we've been doing, which is really, really critical. Previous projections in September, the Fed had foreseen the core PCE reaching 2.6% in 2024 and 2.3% in 2025. So they're seeing that their policies are working. They're dealing with lag data, which is a whole nother issue. I mean, we've talked about this on Knowledge Brokers. I know Byron's talked about it on the hot sheet here. And what has happened is that rental data specifically is very lagged. And that was holding up the inflation's numbers. And Barry Sternlight, who made this prediction, I would say he's right at this point. When the rental numbers caught up, what ended up happening was inflation came down because they were looking at lag data from almost 12 months ago. The softer inflation picture, which we have here, is that the new forecasts indicate a softer inflation outlook for the next 2 years compared to the last update. So this is all really good news. This is what the Fed wanted. And let's face it, people feel inflation prices when they go to the grocery store, when they're buying, regular groceries, ground beef, eggs, milk, those sort of things. They feel it at the gas station. They feel it in a lot of places, and especially at the gas pump when you actually see exactly what you're paying, and that number is changing all the time. So it's good to see inflation coming down. This is a positive thing because things are expensive in 2023. I don't think there's any question there. So we're seeing inflation's calming down, and that seemed to be the drum that the Federal Reserve was beating nonstop. Hey, we want inflation at 2%. We wanted at 2%. Well, they got a two handle. Take the two handle and let's chill out a little bit. And that's exactly what they did, which I'm very, very happy about. The post-meeting statement, the Federal Open Market Committee stated that inflation has eased over the past year, but maintained its description of prices as elevated, which is what we just discussed. So they're agreeing with what we're seeing, us common folks like me, out in the marketplace. GDP forecast. So committee members upgraded their forecast for GDP, expecting it to grow at a 2.6% annualized pace in 2023, which is a half-point percentage increase from the previous update. So I don't see a problem having a strong economy that has normalized growth. The challenge we saw here, and we saw it in housing, is that the growth was so fast, so robust, that there was a lot of sticker shock there. And what we ended up finding out from all that is, and you look at housing data, home prices rose 49% according to Zillow since the pandemic. So, I mean, that's unsustainable growth. You're growing 2 to 5% year over year. That's normalized, healthy growth. And there is a difference here. So, lastly, the unemployment rate from the Federal Reserve inflation forecast projections were unchanged. And again, we're at 3.8% in 2023 and a slight increase to 4.1. The dot plot shows all this. Again, we're seeing some good things here. So here's the last thing, and then we're going to talk about Chairman Powell's comments. So the inflation measure the Fed uses. So while the public often watches CPI data, that's the Consumer Price Index, that's the cost of goods that consumers buy. The Fed prefers the core PCE, which is the personal consumption expenditures reading, which focuses on what people actually spend, adjusting for consumer behavior when prices fluctuate. So PCE is the number to watch here. And if they're seeing that fall into the twos at 2.4%, they were shooting for 2. You're pretty darn close. It's definitely working what's happened here. So it's time to stop and let this play out a little bit. And remember, data's lagged, right? Like we're in the middle of December, so it's going to be very fascinating to see once the December numbers come in and the fourth quarter numbers are finalized, when there's typically a lot of consumer spending that goes on around the holiday season. So a lot of good news there in terms of what the Fed's been trying to do, and seeing that they're getting results. They're going to stop doing this until they actually get there and let it breathe a little bit. So very, very important there. This was the scary part of yesterday. What was Jerome Powell going to say? Was he going to stick his foot in his mouth again? Was he going to come out and have his actions say one thing and then have a very hawkish tone? This is what every person who was watching the Fed meeting, including myself, including all the experts out there that we talk about all the time. We've had some of them on the Knowledge Brokers podcast. This was the thing that everyone was concerned about. So let's go over some of his comments. He mentioned housing twice in the comments before he did the Q&A, which in the past, Jerome Powell's ignored housing almost entirely. So housing was mentioned twice. At the 219 mark, here's what Jerome Powell said. There's our boy. You should put a Grinch face on him there, Bobby, or maybe a Santa Claus hat. I don't know. This would be very interesting today. So at 219, are we playing the quote here, Bobby? Is this what we're doing?
Yes, we are. And I said he's Scrooge in the thumbnail.
Okay, excellent. My man, speaking my language. Let's play the clip and then react to it.
Improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation.
The holidays are upon us.
Do we get paid for that 1-800-Flowers ad read, Bobby? That's what I want to know. So Jerome Powell didn't screw it up. That's what I'm going to say here. The two comments I picked up was activity in the housing sector has flattened out and remains below the levels of a year ago, reflecting higher rates. Yeah, thank you for the obvious. We've been saying this for months. Higher rates also are weighing on business fixed investment. That's why I'm so grateful to see the market react the way that it did, because once rates touched on 8, I mean, demand was still there, but it was a slugfest, right? And what I anticipate happening here, if rates continue to come down, which this is in line with, I think a lot of us were skeptical where rates would be the end of the year. A lot of people predicted maybe high 5s, low 6s, which we're trending that way now. Again, we saw a rate quote yesterday at 6 3/8 on a 30-year fix locally in the greater Philadelphia area. So the other comment is that Jerome Powell and his colleagues are aware that the high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials. Here we go. I don't need to read it. Play it, Bobby.
For the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective.
All right, let's cut it right there, Bobby. And
in our SCP, FOMC participants.
So not to cut you off, but thank you. We don't need to hear Jerome Powell anymore. So we got a few minutes left here, and then we'll do some Q&A. If anyone's got some questions, just let me know, Bobby. So what I heard from those two statements were that they realize they've priced people out of the market, and affordability has been the biggest concern, especially when you think about first-time home buyers, think about millennials, Generation Z. So the fact that they're actually addressing this, you know, a lot of these people are in rentals, so the payment flip from a rental to a purchase is going to be similar if rates come down, but at 8%, it makes it unaffordable. At 6 3/8 or 6 or 5, that's where things get a lot more affordable. So I think it's important they acknowledge that and talk about the hardships there. I like that comment. I know you had one other question. It was from Ed Lawrence of Fox Business. Do you want to play that clip now?
So it's, you know, it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy in different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
So great question there from Ed Lawrence with Fox Business. And it seems like they've had to adjust a little bit. And what I like is that the Fed is really coming around what people have been talking about all throughout the industry, whether it's finances, housing, mortgages, economics, whatever it is. This is all related together. Monetary policy is absolutely affecting the housing market right now and has for quite some time. And they're mentioning housing. Housing kind of got ignored here. They were worried about cost of goods and other things happening. Now we're seeing that housing is an issue and they're acknowledging progress. And the fact that they're acknowledging progress tells me they're going to adjust their policies, as we saw from a lot of the commentary coming out of this Fed meeting. So here's my tip for everyone here. And then I don't know if there's any questions, Bobby. Just put them up on the screen here. I can fire them off. You're doing your client base a disservice if you're not beating the drum on this right now. A simple text message, a simple email with a video. We actually templated all of this stuff for our team so they can go into the CRM and just send it out. There are people that have been wanting to transact and rates have scared them off. There are folks in the marketplace that would love to hear a house just got more affordable for them. There are home sellers that are going to be doing the same thing because, let's face it, a lot of home sellers, they got to go buy a property. So what I'd be looking at here, and this is, feel free to rip this off, really simple. Hey, Bobby, it's Tom here with RE/MAX following up as promised. Did you see mortgage rates plummeted below 6.5% locally? We're even seeing some people lock in at 6.375. Would it help if I broke down the change in monthly payment for you at these new rates? You can send that text out to anybody. Give them a rate quote. Get something from your lender that you work with. If you are a lender, send out your own rate quote. That's very easy to do. Email's the same thing. And what I would do in an email, I'd send it with a video and maybe do a screen share of where rates are. Use a bomb or something like that. Hey, did you see mortgage rates plummeted? We're even seeing people lock in at 6.375% locally. These are the lowest rates we've seen in over a year. Would it help if I broke down the change in monthly payment for you at these new numbers? I'm not sure if this would be for you, but would you be open-minded about jumping on a quick call to discuss your real estate goals in more detail now that your affordability has gone up? Simple stuff, effective conversations, and you're asking questions, not telling people. This is where you can separate yourself from the rest of the agents in your marketplace. I cannot stress this enough. I'd be having this conversation every single day, videos, text messages, emails, phone calls, obviously, because you have to engage them on the phone. There's a lot of opportunity here. And the consumers are going to work with the people that keep them informed, not the other way around. Bobby, you got any questions here? Anything we need to answer?
No, sir. Let's bring it on home.
All right. So honored to be on the post-Federal Reserve meeting hot sheet. There's a lot of value here. And if you like the value that I'm delivering, we got a whole lot more for you over on BAMX. And if you don't know what BAMX is, it is the complete set of notes and slides of everything we reviewed today. Every single day. All you got to do is sign up. It's where you can get access to all the hot sheet daily downloads, courses with me handling objections, Lisa Chinati talking about CRM management, which will help you sell more houses, bi-weekly masterminds, the BAMX community, which includes people like Byron Lazine, Eric Simon, the broke agent, social media savant, and tons more. Use the code. I have a code, Toole23. That's TOOLE 23 for 10% off your subscription at the link in the description here. And if you got some value out of this, drop a comment below. I'm happy. I'll jump into the comments later, answer anything that you got. I'm Tom Toole. That's it for today's hot sheet. Grateful for everyone tuning in. We'll see you next time.